Okay, this video is going to continue video number 90, where we introduced and talked about the basics of selling put options, how to execute the transaction, how to find a month and a strike. And of course, we went over the risks of the dangers of recklessly selling put options, right? This video, I want to talk about some more nuanced risks or maybe hidden risks of selling puts. And I guess, first of all, most people would say that the worst possible thing that can happen to you when you sell a put option is for the stock to go to zero or to completely plummet and go way below the strike price that you sold. And so you get this little upfront premium, and in return you signed up to buy the stock at the strike price, and you're going to have to take a near total loss by buying the stock at a much higher strike price than the stock price traded at later. That is a bad thing that can happen, but it's definitely not the worst thing that can happen when you sell a put option. The worst thing that can happen is you sell a put option and get your $300 or $400 in premiums up front, and then the stock goes to infinity and you're not long. That is the worst thing that can happen when you sell a put option. And there's lots and lots of ways to suffer with options, but that one might be the worst. And you can also have it happen with covered calls, right? Where you buy the stock, you sell a call option, and then the stock blows through your strike price that you sold and goes to infinity, right? And you're going to see it get taken away from you at a much lower price with a covered call strategy. Well, with selling a put strategy, you just get the premium, you're not long a single share, and you're not actually participating in the prospects of this company at all, basically, as long as it stays above the strike price. So I guess what you want to think about is, if this is genuinely a stock that you want to own, well, own it. So it's okay to sell put options, but also go long the stock too, or you can structure certain options trades, transactions that will capture some of the upside, and we'll do another video on that perhaps. The synthetic collar is one way to do this. But what I would say is kind of do like what Buffett did when he was buying his Coke stake. He actually sold quite a number of put options in Coke while he was buying his Coke stake, but that was just gravy. It was just sort of a frosting kind of. The main buy was him wanting to get long the stock, which he did, and then he used some put option selling as a way to produce incremental income. If it's a stock you really want to own, you should own it, right? And if it's a stock you don't want to own, maybe you want to rethink selling a put option in that stock, because you might end up owning it under crappy circumstances, okay? So this is the type of risk that's maybe a little less visible, the risk of not being long, right? And you're not going to know which stock goes up a ton until after the fact. And you just want to make sure that you're aware of this risk and it's a potential lost opportunity cost for you and your capital. All right, thanks for watching.